Hello and welcome back to my channel. My name is David, and I have been a financial analyst for over 29 years. Today, I would like to share with you my view on spread trading and how I have adapted my approach to stay competitive over the years. Spread trading used to be an activity reserved for a select few. When I started during the 2008 crisis, not many of us in Italy were involved in it, even though this type of trading had been introduced to the wider public 13 years earlier with Joe Ross's book, the first one on spread trading that I ever read. At that time, all you needed were a few basic concepts and a subscription to more research, the only statistic database available, if I remember correctly, to achieve good results. Over the years, more and more traders have ventured into commodities and spread trading, making it a much more widespread activity. Today, it's no longer a niche market. The amount of information available has grown significantly, and anyone, for example, can now access real-time weather conditions in places like Minas Gerais in Brazil or Florida in the United States. This has attracted the attention of funds and investment banks, resulting in some degree of manipulation, albeit on a smaller scale than in other markets. Nowadays, simply subscribing to a statistical database is not enough. Clinging to outdated stereotypes no longer brings the same profits as it once did. Markets evolve, and to stay competitive, you must adapt both your analysis and trading methods. I will demonstrate this with a chart from more research. What you see here is the equity line, which represents the performance of the spreads recommended by more research, with entry and exit optimized for the most favorable dates, from 1990 to 23 Road February 2024. The curve shows significant growth until 2013, with approximately $850,000 in profits. However, from 2014 onwards, the growth flattens. Only 2022, in addition to 2019, was a positive year, but, as shown in the table, it was merely a flash in the pan, as 2023 ended with a loss of $19,000. Of course, no one takes all these trades, and entry and exit points are optimized, but what these charts clearly show is that relying solely on seasonality is no longer sufficient to make profits with spread trading. You need a more comprehensive approach, as I explain in my mini-course on spread trading, which you can view by clicking on the link in the top right corner. Seasonality is undoubtedly important, but it's not everything you need to know. Nor is it always the starting point for a trade. It's crucial to adopt a flexible mindset and look at spread trading from various angles. I know that many courses suggest starting with the spreads recommended by statistical databases, but there is nothing wrong with beginning from a piece of news or a particular aspect of a chart. For example, I like to focus on anomalies. I study the commodities involved to understand when to enter a position, either in anticipation of a return to normality or, alternatively, in the direction of the anomaly when it's likely that it will persist for weeks or even months. Another aspect, often overlooked in courses, is the ratio, the relationship between two commodities. You can see an example of this with the coffee-sugar ratio chart. Ratios have often provided me with excellent trading opportunities, although these spreads are usually not broker guaranteed, making them more challenging in terms of profit, loss, and margin requirements. For ratios, besides conducting a thorough and clear analysis of the two commodities, it's essential to determine the number of contracts, based on their differing volatilities. These are more complex spreads, but they can be very rewarding. I will wrap up this brief talk by referring back to what I said at the start of the video. You shouldn't view spreads as something rigid, but rather as a flexible tool that you can adapt to your ideas and needs. For instance, multi-leg spreads, those with more than 2 legs, are among the best and most reliable to trade. However, many traders avoid them because they consider them risky. In reality, they are quite the opposite. They can be designed to reduce risk. Let me show you an example. In this chart, you see the coffee KCZ24 less KCK25 spread. Seasonality suggests selling the spread, but current weather conditions in Brazil and Vietnam are driving coffee prices up. In this case, you might choose the KCZ24 less KCH25 less KCK25 plus KCN25 spread. By selling the 4-leg spread, you effectively sell the KCZ24 less KCK25 spread, as planned, but hedge your position by selling the less KCH25 plus KCN25 spread, thereby reducing both risk and potential losses, however, also the possible gains. In this video, I have shared my perspective on spread trading, which, contrary to what is often taught, is not something limited or fixed, but can be shaped according to your ideas and needs. Over the coming weeks, I will delve deeper into some of the topics I have only touched upon here. Thank you for watching this video. I hope the information I have shared today has provided you with new insights to improve your approach to spread trading. Now I'm curious, which aspect of spread trading do you find most challenging or are you most interested in exploring further? Let me know in the comments below, and I will cover it in an upcoming video. If you found these insights helpful, please let me know by giving it a like, and if you don't want to miss any of my future videos, I invite you to subscribe to the channel and click the notification bell. See you in the next video.